On May 6, 2010, the market was calm. Nothing in the news suggested what was about to happen. There was no catalyst, no warning at all. And then, in the span of 5 minutes, the system broke. $1 trillion of value vanished. The market went into free fall, a plunge so violent and so fast, no human could have caused it. Panicked phone calls flooded exchanges and the brokers. Regulators were so blind to this. For 20 terrifying minutes, nobody was in control because the ones making the decisions weren't human. The machines had started talking to each other, and no one knew what they were saying. To understand that day, you have to understand the world that finance now lives in. It is a world that exists in microseconds, millionths of a second. High-frequency trading algorithms live inside servers, physically as close as possible to stock exchanges, right up the alley. Some firms even build their own fiber-optic lines, drilling through mountains just to shave off a millisecond of travel time for their data. Because in this world, speed is everything. An algorithm isn't trying to predict if a company will be profitable next year. It's trying to predict the price of a stock in the next 10 milliseconds. They do this through something called latency arbitrage. It's simple, brutal physics. By being closer to the information, their algorithms can see the future. By a few millionths of a second, they hear the whisper before anyone else hears the shout. This isn't investing, it's a race. Race against time. And humans are no longer fast enough to even compete, not the average Joe Schmo. But speed is only half the story. The other half is deception. Algorithms have been taught to create ghosts in the machine. It's called spoofing. An HFT, high-frequency trading algorithm, will place a massive order to buy or sell a stock with no intention of ever executing it. It's an illusion, a digital mirage designed to fool other traders, both human and machine, into thinking the market is moving. Once they react to the lie, the algorithm pulls its order and trades against them in the chaos. Now imagine thousands of these algorithms from hundreds of competing firms all doing this at the same time. They aren't just trading the market anymore, they are the market. And it's a market built on a foundation of lies, told at the speed of light. What regulators and economists now fear is that we have built a system so complex and so interconnected that no one can predict how it will behave. Every day on the unseen battlefield of the market, rival algorithms are at war, high-speed war. They are constantly learning, adapting to each other's strategies. One algorithm learns to detect spoofing, so another develops a new tactic to hide it. It's a silent, high-speed evolutionary arms race. But every so often, an unforeseen interaction happens. A black swan event. A feedback loop no one designed. A cascade of failures that triggers a system-wide convulsion. That's what happened in 2010. One algorithm trying to sell a large order triggered a wave of selling from other machines. They reacted to each other, amplifying the panic in a digital echo chamber, until the entire market structure buckled. The regulators could only watch the wreckage in the aftermath. We've since built defenses, circuit breakers that automatically halt trading during a crash, kill switches designed to pull the plug. But these are band-aids. They are reactive measures on a system that is fundamentally proactive. They treat the symptom, not the cause. The debate continues. Does the liquidity provided by these machines justify the risk? But perhaps that is the wrong question. We built these algorithms in the pursuit of ultimate efficiency, the efficient market theory, to eliminate human error and emotion from the market. But what we've created instead is a new kind of physics, a system with its own emergent laws and its own catastrophic natural disasters. We are no longer masters of this machine. We are just living inside of it, hoping it doesn't break.